And another sector lying right in the path of the debt crisis is commercial real estate. Construction and sales have been surging, but that could change if lawmakers and the president don't come to a deal. In fact, some say damage has already been done. Diana Olick has more.
In cities across America, the scene is similar. Bulldozers and cranes coming back to life post-recession. The improving economy is fueling commercial construction as demand for offices, retail space, and multifamily apartments rises from the ashes.
There's a lot of momentum in commercial real estate. There's a lot of property sales. Activity is much higher than it was a year ago, certainly than it was 2 years ago.
Commercial property sales volume is on track to surpass $300 billion this year. That's up 380% from the low in 2009. Sales spiked in the final quarter of last year on speculation of higher tax rates. Imagine what would happen in the reverse if a debt default caused a spike in interest rates.
Commercial real estate is very interest rate sensitive and credit dependent and long term. Those are not good formulas if you have a high interest rate environment or an environment in which credit is volatile.
Commercial real estate is a highly leveraged business, depending on big banks and investors in commercial mortgage-backed securities. Banks have been very leery of real estate risk, but in the second quarter of this year, there was a net increase in lending on construction projects for the first time since the financial crisis. At Maryland-based Walker & Dunlop, a commercial real estate finance company, the view is positive for the long term, but uncertainty is weighing on both borrowers and investors.
The most discouraging thing that we're seeing right now is that this Congress is going to go through yet another crisis and probably end up kicking the can down the road, but not even as far as many people would like to see it get kicked.
While interest rates haven't moved much during the run-up to the debt deadline, just the anticipation of it has hurt investor confidence. Even if the deal ends up being a punt, that is, delaying any decision until early next year, commercial real estate financing will still take a hit.
Any of these disruptions that imply more risk, that make investors worried about what's happening with the bond market, that can push interest rates higher, not because the Fed is stepping away, but because there's fundamentally more risk in the market. Those are things that really hurt commercial real estate.
And may already have. Diana Olick, Nightly Business Report, Washington.